Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, a top U.S. bank warns of hellish consequences if the credit markets break. And we're going to make the case of why they are and exactly how the banks intend to trap investors in these garbage products. Now let's head over to Bloomberg, where we picked today's story up with the headline as Jamie Dimon of JP Morgan Chase says it could be hell to pay if private credit sours. And it's always the case in a debt-based economy. When things go wrong and financial crises hit, it's always in the credit markets. And this time the banks, as you're about to see, have a plan to trap investors in garbage products, just like they always do. As Jamie Dimon said, he expects problems to emerge in private credit and warned that there could be hell to pay, particularly as retail clients gain access to the booming asset class. And this happens with anything. When you take a look at the stock market, when it goes higher, what do investors do? They chase it with money. And here you have a case where more money is chasing a market that everybody wants in. And when that happens, the banks and the investment banks alike, they create more and more products to suck in investors' money. And then when things go wrong, well, you find out you can't get your money out. Do you want to give access to retail clients on some of these less liquid products? Well, the answer is probably, but we don't want to act like there's no risk with that. And that's exactly the game. Create garbage products that have limited liquidity provisions and dump them on the market to eager investors. It's a game we play every time. And of course, we know how this is going to end as retail clients tend to circle the block and call their senators and congressmen when they can't get out. But well, it's too late, as Dimon's caution comes amid some signs that trouble may be brewing, as former Apollo partners who run the family business office from Achilles Management and invest across private assets said this month that there are cracks forming in direct lending as money keeps flooding in. And again, that is the problem. When an investment class goes up in value, more and more money gets pulled in. The problem is the banks can't say no. They just create more and more garbage to offload on investors. Of course, we know they come out ahead with bailouts, as meanwhile Moody's last month cut its outlook on direct lending funds with ties to some of the largest fund managers in the space, including BlackRock, KKR, and Oaktree Capital Management. And the longtime CEO wrote in his annual letter to shareholders that the private credit industry has not yet been tested by bad markets, which tend to expose weakness of any new products. And of course, we're going to make the case of why this stress is going to hit this, why it's going to break. But I'd love to know what you think. Do you trust the banks and their investment products, or are you staying far clear from things like this? Make a comment below. I've seen a couple of the deals that were rated by a ratings agency, and I have to confess it shocked me by what they got rated. And again, if this doesn't sound just like the great financial crisis, of course, rating agencies were giving high ratings to these mortgage-backed securities, and they said nothing can go wrong. And of course, everything possible went wrong. This is just another case of offloading garbage onto the public. As Jamie Dimon went on to say, it reminds me a little bit of mortgages, but you know it's doing nothing to stop him and his bank from offloading this stuff to the general public. But one thing you should have been loading up on, well, that's silver. If you look back at this headline from 14 days ago and says, gosh, if I only would have known. You look here, gold, silver, and platinum's red hot rally, still has further to go, stay strategists. But guess what? You could have known because our subscribers did. You see this little green candlestick here? On this day, we flagged to buy it open to our CTA Timer Pro subscribers. And now look at this. Those that took the trade are up 17.2% as of yesterday's close. That is a mere short-term trade with big results. How did we know that? Well, we look at the machine positioning, and we noted that prices was rallying as machines were short. We flagged this change on a report and to our subscribers. We even included a video to give them tip on how to trade it. As you can see, what we do every day when we have that, and that has turned into big results. And here's the best part, you too can make returns like that, there's a 30-day free trial. Check out the description below and get the link. Get trading, make some money, as U.S. GDP growth was slower last quarter on soft consumer spending. So we start to talk about why credit markets are likely to break, because in a debt-based economy, you need a constant expansion of new debt, not only to pay on the existing old debt, but to create growth in the economy. So when you start to see a slowdown, well, you find out it shows up in the economy first, and next thing you know, the credit markets break next. Of course, we know Jamie Dimon knows this, but it isn't stopping his bank from selling this garbage. As we look on, as gross domestic product rose 1.3% annualized in the first 3 months of the year, below the previous estimate of 1.6%. This from the BEA. The economy's main growth engine, personal spending, advanced 2% versus the estimate of 2.5%. So notably, we continue to see a deceleration in the economy. And of course, that means there isn't going to be enough new money created. At some point, there's going to be fractures in the system. Of course, Dimon already mentioned he's seeing that now. Of course, it's only going to get worse if the economy continues to slow. We'll make the case of why that likely is to happen, as the numbers underscore lots of momentum to the start of 2024 after continual upside surprises last year. High interest rates, waning pandemic-era savings, which are really at multi-decade lows, and slower income growth are some of the key factors weighing on American households and businesses. Of course, what they're missing here is relative to price growth still outpacing total compensation. Households are under stress. That is a huge issue for the economy that's going to likely send it on a continued decelerated path. Of course, for the credit markets, that's not good news, as consumer spending was marked down as outlays for goods, particularly autos, were much softer. Federal government spending slowed, while imports picked up compared to the first estimate. Even net exports attracted from growth for the first time in 2 years. So we're not just seeing a slowdown here in the U.S., we're seeing it all over the world, and it's everything to do with the political elites in this country, specifically those central bankers. And what they did was raise short-term interest rates higher than the market expected. This caused something called the yield curve to invert when short-term rates are higher than long-term rates. And because banks make money on the spread, the interest rate spread, when they find out they can't make money on loans, well, they start to curtail lending. And that's exactly what we see in this chart here. The net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. Here shown in blue. And you can see anytime the blue line rises above that horizontal black line, on net, banks are tightening standards. So you can see they're accelerating their pace and they're decelerating their pace. And then what's underneath here, it means they're loosening standards. But relative to GDP, which we're showing here in red on a year-over-year rate of change, you can notate the periods of tight lending standards literally come back to deceleration in the economy each and every time. And of course, when an economy has a massive amount of debt and is sitting on bubbles, and of course you wonder how are bubbles created, it's because asset prices in a certain sector continue to go up and more money floods in. And so what happens, you think back to the dot-com bubble, what happened? Well, there were more dot-com companies to funnel in all this money. What happened during the real estate crisis of 2008 and 9? Well, prior to that, a lot of garbage investments were created to pull money into that sector. Now, of course, we see that all over the place in the Magnificent Seven stocks that continue to go higher in the private credit markets. That Jamie Dimon is now warning that this could break and have absolute hellish consequences, which he's right. And alongside the second estimate of GDP, the BEA also publishes data on gross domestic income, the other main measure of economic activity. It rose 1.5% in the first quarter, which of course compared to GDP, which measures spending on goods and services. GDI measures income generated and costs incurred from producing those same goods and services. And of course, that also included corporate profits. In the first quarter, adjusted pre-tax profits fell 0.6%, the first decline in a year, as after-tax profits as a share of gross value added for non-financial corporations, a measure of aggregate profit margins, with little change at 15.2%, suggesting that we're going to see, of course, earnings come down, profits come down, but that isn't deterring investors, because remember, when you're in a bubble, money starts to flow where price goes. Price goes higher, more money comes in until everything goes wrong. And on the inflation front, the Federal Reserve's preferred metric, the Personal Consumption Expenditures Price Index, that rose at 3.3% annualized for the first quarter. And excluding food and energy, the core PCE gauge rose 3.6%, so against 3.7 the previous estimate. So here we see again things in the economy cooling off faster than expectations, and there's good reason, because the U.S. consumer is struggling with high inflation. They're struggling with their wage growth not keeping pace. They're not getting enough hours worked, and that's translating into less spending. In a debt-based economy, when you see consumers have access to less credit because the banks are telling them no and their spending power weakens, it's only a matter before we get that credit crisis that Jamie Dimon's warning about. And with that will come the hellish consequences. And here's the evidence as we now turn to the retail sector. Foot Locker turnaround shows signs of life. Well, still stabilized, but really, that's not the whole story. Profits excluding some items, while it was 22 cents a share. Look at this. Comparable store sales, a key retail metric, fell 1.8% for the quarter. That was slightly better than expectations, but notably, it still declined, and that's the issue here. How about Kohl's plunges most on record after a huge miss and guidance cut, and you start to look at the U.S. consumer being tapped out. The mid-market department store chain slashed its guidance for the full year after reporting first quarter results that wildly missed on just about every metric. Comparable sales, which measure the performance of stores open for at least 1 year, fell 4.4% in the quarter ending May 4th. Although Kohl's operated, here's this, deep discounts. We talk about how disinflation, maybe at some point deflation, is going to come back in vogue. Well, you're seeing it in the demand side of the economy. Consumers just don't have the pricing power. Inflation's too high. Their debt's too high. Everything is going wrong for them. And here you can see the company said sales of clearance items actually declined, leading the miss on comparable sales. The company's website Thursday said it was hawking sales as much as 85% off. That's not a sign of a no landing or soft landing scenario. That's a sign of an impending credit crisis. And you can see that gross domestic product likely to come down further, which is why we're taking a look at all these retail headlines. As we see here, advanced retail sales in blue leads gross domestic product, suggesting that in the quarters to come, we're going to continue to see a deceleration in GDP growth. Not what, of course, the current administration is looking for in hopes to get reelected and back in the White House, and certainly not what the political elites that run the central banks of the world are looking at. The problem is they're in denial mode, as you'll see here shortly. It's over to Best Buy now, which jumps 10% as cost cutting preserves profits, but despite sluggish sales. So you see this kind of view, the market is just buying anything, but the reality is consumers aren't. And here we see Best Buy sales have been sluggish as the company deals with the aftermath of roughly 2 years of unusually high sales during the COVID pandemic. And that's something the economy around the world is getting adjusted to. During the pandemic, there was so much money borrowed by governments and stuffed in consumers' pockets that everyone got the idea that this was the new normal. The problem is now we're adjusting back down. And when you adjust down and come off that sugar high, you don't go back to where you were. You usually go underneath it. That's something that everybody is going to struggle with, particular investors, as the retail has been in the middle of a waiting game for the replacement cycle of laptops, kitchen appliances, and more to normalize, and for the debut of new tech gadgets to get customers in the stores. But they've noticed a pullback on purchase of discretionary items as consumers manage higher costs because of inflation. It's not just inflation, it's the fact that they're not seeing enough demand on the, of course, the side of their employer to continue to drive wage growth and a number of hours worked to meet the needs for the average American. They're cutting their spending, and of course that's going to lead to, well, as you already know, more layoffs. As Barry said, customers continue to seek value and hold back when it comes to pricier purchases. The quarter was more promotional than expected in both the number of deals and the size of discounts. So again, we start to see that retailers are competing for consumers' dollars by offering discounts, and once they start the cycle, it's going to get more aggressive. And here in the U.S., despite despite the fact that their stock price rallied today. Comparable sales dropped 6.3%. Online sales tumbled 6.1% year over year. Of course, they noted they're also cutting spending. The company would lay off workers and cut costs across the business. She did not specify the number of layoffs, but said Best Buy would invest in areas that could drive growth like AI. Of course, we know that as you put more and more people on the unemployment line, their spending power decreases. They still have bills to pay. They still have debts to pay. And all of a sudden, that drop in discretionary spending, again, you create this cycle all the way down. But as you turn even to the central bankers, in their own reports, they acknowledge something's wrong, but don't ask them to change. As Fed's Beige Book points to modest growth in the U.S. economy and prices, retail spending was flat to up slightly, reflecting lower discretionary spending and heightened price sensitivity among consumers. Overall outlooks grew somewhat more pessimistic amid reports of rising uncertainty and greater downside risk. And yet we continue to hear from the central bankers, well, inflation's a problem. We have to keep rates higher. We just can't cut them. The problem is you're going to see what's going to happen is the floor of the U.S. economy is going to start to fall out. The central bankers are not going to acknowledge it, saying, well, maybe this will get us down to target. And when they break through their target range, you're going to watch all-out panic from the top here. Employment rose at a slight pace, with 8 of 12 districts reporting negligible to modest job gains. This is not the evidence of a no landing or soft landing scenario. Several districts reported wage growth or moving toward pre-pandemic levels. That's something we've noted. There is a huge deceleration going on, and wage growth is showing up in the discretionary side of the economy as retailer after retailer notices spending habits have changed and discounts are coming back in a big way. But Fed's Bostic says many inflation measures now are moving toward target range. The only thing that's not moving is, well, his notion to cut rates. My outlook is if things go according to what I expect, inflation goes slowly. Again, that's their base case, that we're going to get that soft landing, the labor market slowly and orderly moves back into sort of a weaker stance, but a stable growth stance. I'm looking at the end of the year, the fourth quarter is the time when we might actually think and be prepared to reduce rates. Of course, what he doesn't realize is what these retailers are suggesting. If they don't see sales increase and increase very soon, in the matter of next couple of months, they're going to cut more hours, they're going to cut more heads. It's going to happen, and you're going to watch these targets that the Fed has get blown through to the downside. As the Atlanta Fed chief said, many of the different measures of inflation he looks at on his dashboard quarter moving back into the target range. Again, well, that is until they blow through right through the bottom, and that will lead us right into those hellish consequences that Jamie Dimon's warned about when the credit market breaks and sends the U.S. economy into an all-out financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.